Welcome to 𝘠𝘵𝘪𝘶. I'm Mr. 𝘍𝑧𝐵𝐴 and I take advanced financial reporting. Today I want us to go through a topic in advanced financial reporting, which is under assets and liabilities, specifically a subtopic known as financial assets and liabilities. Therefore, we are going to start with the introduction. Then you write financial assets and liabilities. Financial assets and liabilities are contractual arrangements. Which give one party a right to receive cash or any other asset, into brackets financial asset, or an obligation to give cash, or any other asset, into brackets financial liability. Then below that you write types of financial assets and liabilities. Number one, we have available for sale. Financial assets. Available for sale financial assets. Then you write below that these are non-current assets. That are held by an entity. These are non-current assets that are held by an entity with a primary motive of being sold. On demand. Full stop. Initial recognition on these assets is made at cost. While subsequent measurement is made at fair value. The other one, number two, is financial assets at fair value. Through profit and loss. These are short-term investments. That are reviewed from time to time. To ascertain their gain or loss. On subsequent measurement. full stop. They are measured at fair value. They are measured at fair value. And any gain or loss, they are measured at fair value. And any gain or loss on such assets, and any gain or loss on such assets is treated as an income or an expense, is treated as an income or an expense in the income statement, Number 3 is held to maturity. Financial assets. These are financial assets. These are financial assets that are held by an entity for a specified duration. These are financial assets that are held by an entity for a specified duration, upon which the asset is transferred to another party. Full stop. These financial assets are measured at their fair value. They are measured at their fair value. Then after that you write below that hedging of financial assets and liabilities. Hedging of financial assets and liabilities. Hedging. It is the act of shielding. It is the act of shielding financial assets and liabilities. The act of shielding financial assets and liabilities against potential risk. Financial assets and liabilities against potential risk. Full stop. There are generally two types of hedging. There are generally two types of hedging. Namely, number one, cash flow hedge. Number one is cash flow hedge. Then you write below that cash flow hedge. It is used to manage risk. It is used to manage risk. It is used to manage risk. It is used to manage risk changes in the expected cash flows. It is used to manage risk changes in expected cash flows. Full stop. It is made when the cash flows expected from a financial assets, are subject to uncertainties, which are likely to affect an entity adversely. Full stop. A cash flow hedge may be made, by investing in an investment, A cash flow hedge may be made by investing in an investment whose cash flows are not affected by the performance of the financial asset, The other type of hedge is known as a fair value hedge. The other type of hedge is known as a fair value hedge. It is a price that would be received. It is a type of hedge, It is a type of hedge which involves an arrangement, to mitigate the risk changes. In the fair value of a financial asset. Risk changes in the fair value of a financial asset stroke liability. Financial asset stroke liability. It is made when the fair value of an asset or liability, is likely to be adversely affected, by factors such as economic conditions, natural calamities, political instability, etc. Then below that you write a subheading, embedded derivatives. embedded derivatives. Then you write below that it is a derivative, that is combined with a non-derivative host. It is a derivative that is combined with a non-derivative host contract. That is combined with a non-derivative host contract. Full stop. Full stop. A good example of an embedded derivative is a put option. Which is attached to an equity instrument. Full stop. A paragraph below that. An embedded derivative should be separated from the host contract. Should be separated from the host contract and accounted for as a derivative. Full stop. However, where it is impossible, to separate it from the host contract, it should be treated as a financial asset. Held through profit and loss. A financial asset held through profit and loss. Then you write below that NB note financial assets should be recognized in the statement of financial position. Financial assets should be recognized in the statement of financial position. Under assets. While any interest accruing from such assets, should be treated as a finance income. should be treated as a finance income in the income statement. As a finance income in the income statement. Full stop. Financial liabilities should be treated in the SFP. Financial liabilities should be treated in the SFP as current or non-current liabilities. As current or non-current liabilities. As current or non-current liabilities, while any interest accruing on such liability, from such liability should be treated as an expense in the income statement. Should be treated as an expense in the income statement. To illustrate that treatment of financial assets and financial liabilities, I'll now take you to a past paper question of September 2015, question 3A. I'll now take you to a past paper question of September 2015, question 3A. The question reads, 𝘵𝘱𝘈 Limited purchased a zero-coupon bond for $600,000 redeemable in 5 years on 1st January 2014. The effective interest rate is 10% and the bond is carried at amortized cost. So in this case, it is 𝘵𝘱 Limited which is purchasing a zero-coupon bond. So that means that 𝘵𝘱 Limited is acquiring an asset. Then you are required to show the valuation of the bond to be reflected in the statement of financial position as at 31st December 2015, 3 months. Then the finance income for the year ending 31st December 2015. So as we have just commented, a financial asset will give rise to a finance income in the income statement. So let's start where it's easier when you start with showing the finance income and then you show the SFP. So you write 𝘵𝘱 Limited income statement extract. Income statement extract for the year ending 31st December 2015. For the year ended 31st December 2015. Then you will have our figures. You'll have let's have 2014 and 2015. In 2014, incomes, you'll have incomes. Finance income that will be recognized in 2014 will be 10% of 600,000, which I believe is 60,000. But remember, what the examiner wants is not the finance income of 2014, but rather that of 2015. So for 2015, it will still be 10%, but on the cumulative amount, which is 600,000 plus the interest of the first year, which is 60,000. So in other words, it will be 10% of 660,000, which gives you 66,000. So what the examiner is looking for is the finance income of 2015, which is 66,000. Then from there, we go to the SFP, the Statement of Financial Position. You write 𝘍𝘋𝘈 Limited, Statement of Financial Position. Extract as at 31st December 2015. Statement of Financial Position as at 31st December 2015. Therefore, it will be non-current assets we have a 10% zero coupon bond. Zero coupon bond. So it will be 600,000, which was the original value, plus interest of the first year, 2014, which was 60, plus interest of 2015, which was 66. This gives me a total of 660 by the end of 2014. And by the end of 2015, it will be 660 plus another 66,000, which comes to 726,000. The amount that will appear in the SFP will be 726,000. So supposing that you are even asked to give for 2018, or rather 3 years down the line, you still follow the same procedure of accumulating interest on the financial asset. And again, supposing that 𝘍𝘋𝘈 Limited had sold or had issued this coupon, zero coupon bond, supposing it was not purchasing, it was selling, then it means that the same amount would have been accounted for as a non-current liability, but the procedure is the same. It would have been accounted for as a non-current liability. The procedure would have been the same. And again, remember, when you're preparing the income statement extract, the 66,000 will be shown under expenses. That is finance costs. That's the only difference between accounting for a financial asset and accounting for the financial liability, because they are each is the opposite of the other one. So basically, that's how you show the financial statements extracts in case of financial assets and financial liabilities. So in summary, what we are saying, as far as the topic is concerned, you need to know the introduction part of it. You know what are financial assets and what are financial liabilities, how they arise. Then from there, after you know what they are, you know their categories or classification, or rather the types of financial assets and liabilities. We have indicated the types of financial assets and liabilities. Then from there, you know the concept of hedging. You know what hedging is, and you know the two basic or the two general types of hedges that are available. Then you know something about embedded derivatives, what it is, what is an embedded derivative, and an example of an embedded derivative. Then from there, you know how to account for assets, financial assets, and how to account for financial liabilities. And as far as that subtopic is concerned, you'll be well prepared. So having no other issue as far as the topic is concerned, I intend to stop at that for now. So have a nice time. Thank you.